Coles fell 3.3% to $20.44 on Thursday, brushing a 52-week low that the defensive staple thesis was never meant to permit. The thesis on Coles has always been simple: inelastic demand, duopoly pricing power, dividend reliability through any cycle. Justice O'Brien's ruling does not break demand, it breaks the mechanism by which that demand was monetized. The 12-week price establishment window he imposed is not a fine, it is a permanent constraint on the down-down promotional engine that drove margin through the inflation cycle. Main thread of the reset, the $630 million in market value erased on the day, prices in a fine that has not yet been quantified, with Allen Fels flagging hundreds of millions and the statutory maximum running at $50 million per contravention across 245 products. Capital did not flee Coles because of the headline number, it fled because the playbook that justified the multiple has been ruled unlawful. What the tape has not yet priced is whether the same playbook sits inside Woolworths. The reason Woolworths dropped $512 million in market value on a day it was not the defendant is that O'Brien is also the judge in its prices dropped case, heard in late April and reserved for judgment later this year. This is the convergence point: one judge, one legal framework, two near-identical fact patterns, and a 12-week precedent already on the record. The supporting case for Contagion is structural. The Coles judgment cites perceived competitive pressure from Woolworths as the reason Coles cut its own guardrails from 12 weeks to 4 in March 2022, which means the court has effectively named Woolworths as the upstream cause of the conduct it just penalized. Countersignal worth weighing: Woolworths stopped using the disputed discount style after being sued, which may compress its liability window relative to Coles' February 2022 to May 2023 exposure period. That mitigates the fine, not the precedent. The precedent is what reprices the sector, because it converts a Coles-specific governance failure into a duopoly-wide regulatory ceiling on promotional intensity, and promotional intensity is how both names defended share against Aldi. The Guardian CW scanner data is the reversal card the market has not yet metabolized. 10 tracked products: Oral-B kits, Ristorante pizzas, Blackmore's fish oil, Quilton toilet paper, mini magnums, flipped between promotional and full price at Coles and Woolworths in near-perfect sync, often swapping on the same day. Consumer behavior expert Christina Anthony called this commercially rational rather than collusive, and that distinction is exactly what should worry holders. Rational coordination without collusion is the textbook definition of a duopoly extracting rent through tacit pricing discipline, and it is precisely the pattern that invites the next regulatory expansion once the down-down precedent is bedded down. The ACCC supermarket inquiry failed to produce findings on excessive pricing. This litigation route just succeeded where the inquiry failed. The implication for capital is that the regulatory cost of running the duopoly playbook has stepped up permanently, and the political appetite to step it up further is now backed by a federal court win. The moat has not disappeared, its maintenance cost has been re-rated. JP Morgan's overweight call on Woolworths at $37, lifted on 19 May, 5 days after the Coles ruling, argues the market overreacted to the Q3 margin scare and that the franchise is still gaining share. The relative value frame the upgrade implies, Woolworths at $34.33 with 7% upside priced in, Coles at $20.44 with an unquantified fine, a class action led by GMP Law, and a reserved judgment all overhanging. Condition that resolves the gap: if O'Brien's Woolworths verdict lands materially lighter than Coles, plausible given the earlier behavioral exit from the disputed format, the relative value trade tightens and JP Morgan's thesis carries. If the verdict mirrors Coles, both names converge downward and the Aldi substitution case strengthens, because Aldi's everyday low price model is structurally immune to the 12-week rule that just trapped its larger rivals. The checkoff anchor is the 10 June return to court on Coles penalties and the pending Woolworths judgment. Those two dates, not this week's tape, are the verification benchmarks for whether the defensive staple thesis survives in recognizable form or gets rewritten around a regulated promotional ceiling. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.